Welcome, everyone. This is Scott Davila. I'm Vice President of Marketing and Client Relations here at Capital Management Corporation. Thank you for attending today's Capital Management Corporation September webinar. We have quite a few folks. And just as in the past, our presentation will be about 30 minutes, and then we'll get into Q&A. We already have several questions that have been sent to us that we will address. A little bit of housekeeping. If you have a question during this presentation, you will see on your screen a bar with several activities that you can do, and one of them will say questions. You can click on the caret on the left. You'll get a drop-down menu, and you can type in your question. You can send it to Capital Management Corporation, or you can also send it to the audience as well. But we'll get to those at the end. And last item is that we are recording this, as we typically do, and we will have it up on our website sometime tomorrow, and you'll certainly get an email alerting you to when it is up on the website. So let's go ahead and get started. Joining me today are Tim Call, who is President and Chief Investment Officer of Capital Management Corporation, and Mark Lavsay, who is Vice President and Portfolio Manager. Agenda is typical agenda that we present during the webinar. Mark will go over the economy. Tim will go over investment opportunities, and we do have an election coming up in 53 days, so we're going to just show some historical data and trends on that as well. So with that said, I'm going to go ahead and pass it to Mark.
Thank you, Scott. As many of you have probably seen this chart in client presentations or a similar one, we're just kind of highlighting what I'm going to be covering here today. So I'm going to be focused more on macroeconomic issues like inflation, unemployment, and interest rates in a few charts here. So the first one is on everyone's favorite topic over the last couple of years, which is inflation. We got hot off the presses numbers just this morning for the most recent data that is represented on the right side of the chart. In this case, it's for the last month, August of 2014. Overall, the basket of goods in the CPI rose 2.5% from a year ago and was up 0.1% from July. This does represent the smallest increase in the CPI since early 2021, so that's positive. We also see the different categories that make up the basket of goods in the CPI basket. We wanted to put 1 month of data in perspective. So we also have chosen to include the June 2022 report, which happened to be the high watermark of inflation during the cycle. So you can see how things have changed between June 22 and August of 2024. So we topped out at 9.1% in that period, and now we're at 2.5%. So meaningful progress has been made in reducing inflation. We would note that today's reading remains comfortably ahead of the stated Federal Reserve target of 2.0%. And even though the rate of change has slowed, prices have still continued to rise after the peak rate of change in 2022. So even though inflation rate is lower, it doesn't mean that prices are lower than they were when we peaked out in 2022. Looking at the different components, the shelter component is the biggest driver of inflation in recent periods, August being one of them. Whereas in July of 2022, we had energy, transportation, core goods, and food being much larger contributors. Back in 2022, the echoes of the pandemic had a much larger impact on pricing. Government stimulus and lack of availability of goods drove prices up. Today, those impacts are much lower, and it appears that a shortage of homes available for sale is likely having the largest impact. While Fed actions may lower mortgage rates, the impact to home prices we don't feel will be controlled by the Fed, Simply, we need more supply of homes to help lower prices. Next, I'm going to speak about the labor market, which has slowed. This data is provided by the Bureau of Labor Statistics, and on this chart, we're showing total non-farm job openings, which is the blue line, and the rate of unemployed and discouraged workers in the red line. So if we focus on current levels, which is obviously on the right side of the page, versus the overall period, essentially since before the global financial crisis in 2007, 8, and 9, we see that unemployment remains relatively low and job openings remain relatively high, signaling a healthy labor market. If we do focus more on the right side of the page in recent trends, we see that job openings have fallen by more than a third since 2022, and the unemployment rate has ticked up nearly a full percentage point since early of 2023. So it's clear the labor market has cooled over the last 18 to 24 months. The BLS provides monthly job gains or losses on the first Friday of the month for the prior month. This report tends to generate a lot of media attention and can have an outsized influence on short-term moves in the market. We would caution our clients and any long-term investor about putting too much weight into the monthly employment report. First, we think it's unwise to overreact to any one piece of information. Secondly, and perhaps most importantly, this data is released early in the month and is revised as more data becomes available in the following 2 months of the original report. Recently, employment numbers have been consistently revised lower. Last year, in 2023, 10 months were revised lower, with only July and December revised higher. And so far in this year, only March has been revised higher, with data complete through June. In addition to those revisions, the BLS also makes an annual revision to correct for survey error. We got this annual revision in early September. This year, the revision took away 818,000 jobs. This is for the period of April 1st, 2023 to March 31st, 2024. And although the 818,000 jobs lost or not gained is a small percentage of the 161.5 million working people, it was roughly 30% of the average jobs added over that 12-month time period. So if you look at the average jobs added from April 23 to March 24, it was 220,000. And if you take away roughly 68,000 of those per month, it's about 30%. In contrast to this, with these revisions being lower, in 2021, when the labor market was very, very hot, 11 of the 12 months were revised higher. So in short, revisions are very commonplace and tend to be in the general direction of employment trends. So when revisions are typically lower, it means typically things are weakening. And when revisions are higher, it means things are typically getting stronger. So recent trends have cooled in the labor market. However, the overall levels do remain relatively healthy. So in this context of lower inflation and employment trends changing negatively, what is the Fed to do? The Federal Reserve has 2 stated mandates: maximum employment and price stability. In this context, price stability is just another way of saying not too much inflation and also not too much or any deflation. Over the last 2 years, inflation was very hot, and the labor market was very hot as well, as we showed on the prior 2 charts. So the Fed increased interest rates quickly. They started too late, but they did quickly once they got going, to try to cool inflation and maybe even cool the labor market. Today, inflation is much closer to the Fed's target than it was 2 years ago, and employment is trending in a more negative direction. the Fed has clearly signaled that they will lower interest rates at the next meeting, which is September 18th, a week from today. I'm going to quote Chairman Powell in his Jackson Hole speech here, and this is about as clear as they get when they're talking. They don't really like to say too much, but here's a short quote from Chairman Powell. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. So that ends the quote, but it's about as clear cut of a case as you get that he's signaling a upcoming cut in rates. And this chart shows the market expectation is that the Fed will reduce rates by either 0.75% or 1% by the end of the year. So there's 3 more meetings this year, one in next week, one in early November after the election, and one in December. I'll remind people that the market has not been very accurate in predicting Fed rate moves. Remember earlier this year, most believed that the first rate cut would be in February or March, which did not happen, and that the Fed would cut 6 to 8 times by the end of the year, which is likely not to happen either. So we believe this first cut next week will be 25 basis points or 0.25%. The Fed is typically slow to move when they change policy. And since we don't have an active crisis on our hands, we see no reason that the Fed would cut by 50 basis points, which is the other option that the market believes may happen. This is also the last Fed meeting before the November election, and the Fed does not like to be seen as very political, so we think they'll be more conservative in their initial move. So it begs the question, what happens typically in the market after the Fed cuts rates? So this chart shows the first Fed rate cut and what happened in the following 12 months, going back to the 1920s. So we have a long history of this. Typically, the market does well for the year following the first rate cut. This chart shows that the market's been higher 12 months after the first cut in 12 out of the 14 instances. If you're worried about the 2 where it did not happen, we do think those were both unique circumstances. The first was in early 2001. The tech bubble was popping at that time. And we also experienced the terrible attacks 23 years ago today that impacted the markets in that 12-year period. So that was a little bit unusual. The second was in 2007 when the housing bubble was bursting or about to burst, and we were headed into the global financial crisis. We believe the most likely outcome this time for this rate cutting cycle is the more normal outcome, meaning that certain stocks will do well over the next 12 months as the Fed moves to lower interest rates and lessen the interest rate pressure and restrictiveness on the economy. So now I'm going to pass it over to Tim, and he's going to go into more detail about just what kind of stocks we believe are well positioned for future growth in this environment.
Highlighted on this chart, we see several recurring trends that take place in the market. And we know long term, when we look at 50 years and 100 years, value stocks outperform growth stocks. Small caps have outperformed mid caps, and mid caps have outperformed large caps. Dividend growers have outperformed dividend payers, and dividend payers have outperformed the indexes and non-dividend payers. And cash cows, or companies that generate lots and lots of excess cash, they tend to outperform story stocks, whether those are unicorns riding rainbows or just idea stocks, something that sounds good but might not make money for many years and might file for bankruptcy in the meantime. So those work long term. Those do not work late in a large cap growth cycle. Everyone wants the same excitement in a large cap growth cycle, and there are fewer and fewer names that people are drawn to. Those are the mega caps, and they get more and more expensive, and until it ends. And there could be some macro matters like what Mark discussed that are catalysts for it to end. But generally, what we see an end after a period of time. The longest large cap growth cycles have been 10 years previously, ending with the dot-com bubble and the Nifty 50 in 1974. And this extended large cap growth cycle has been longer than that. So it's overdue to change leadership. The problem is no one likes anything that's on sale when it comes to the stock market. And value, dividend growth, small caps, mid caps, and cash cows are on sale. It's a great entry point, even though people are more excited about the mega caps right now. We see on the next chart that we believe we passed the inflection point, and we think leadership is changing. Last year, the mega caps were roaring, and the S&P 500 is a market-weighted large cap index. It outperformed the other major large cap index, the Dow Jones Industrials, by roughly 10 percentage points. That's almost unheard of. Usually they're within 1 percentage point of each other in a typical year. And then again, during the first 6 months of this year, the S&P 500 outperformed the Dow Jones by roughly 10 percentage points in just 6 months. Again, rather unheard of. It's extreme move, and we usually see extreme moves like that at the very end of an extended cycle. And that's what we believe has happened. And we look at other areas that tend to outperform over time, and they were also lagging the S&P 500, which is very tech heavy, very mega cap heavy. But we look at the last 2 months, or this quarter to date, and we see the S&P 500 is down and the other indices are up. We think this is just the beginning, and when we look at the next 3, 5, 10 years, we would expect the bars on the right to be progressively higher than the S&P 500. So it makes sense that small caps and mid caps will do much, much better, and dividend payers will even do better than the S&P 500 over the next 3, 5, 10 years. So everybody's drawn to the best performing index, and that's when the index peaks, and you really want to be in the other areas. Now you can do possibly even better than that. So if you wanted to buy a small cap or mid cap index, you'll be buying all the stocks in that index. Those that don't pay dividends, those that don't have positive cash flow, companies that aren't growing, companies that might be expensive relative to others. You don't have to do that when you're selecting individual stocks. You can own the companies that have positive earnings, recurring excess cash flow generation, that reward shareholders with dividends and share buybacks, that are at attractive entry prices. And so you can do better than the indexes. We're very, very excited about how we're positioned, and both the long-term growth and these entry prices we're finding with individual names. An example of categories of these recurring cash cows that we own includes some in the rare material space. Agnico and Wisdom mine gold. Arcadium lithium, you might guess, it generates lithium. It produces lithium, which is needed for batteries and a lot of new technologies. One important feature of these companies is their geographic exposure, and that they're in stable countries with rule of law. A lot of other rare earth material and precious metal companies are in questionable areas, and they end up in trouble from time to time. And we certainly like to avoid that. Another feature of these companies is they're some of the lowest cost producers of these metals and materials. That helps when you're going through a cycle. As we are with lithium right now, the average producer is losing money at low lithium prices today. Arcadium Lithium is likely the only major lithium producer that's making money at current prices. So others might have large cutbacks. Some might go out of business. And as the cycle turns and lithium prices rebound, not only will Arcadium's profits grow that much faster, but its market share will grow even further because some of its competitors have been pushed out of the way. So we're very excited about the prospects of these companies. Some people ask us, well, gee, is it better to own gold or a gold miner? I tell you, if gold prices go up by $100, that's nice. You can make a single-digit return on the commodity. If they go up $100 and the profit margin of some of these companies is $100 an ounce, then in theory, the profitability of these companies can double as their margins go from $100 an ounce to $200 an ounce with just a $100 an ounce price increase in gold. Other examples of cash cows we're finding that the market's overlooking right now include names in the financial sector. And most people think of financials as banks. We only own one bank firm-wide in a city. But as we go around the clock here, you see great diversification in types of companies that we own. So these are growing excess cash generators that like to reward shareholders and are at great entry prices. They include CME Group, a leader in commodity exchanges, in futures and options. Goldman Sachs, a leader in brokerage services. Moelis, which is not a household name, but they are great at helping with mergers and acquisitions, and even helping companies through bankruptcy. So they can help through all sorts of economic environments. Like several of our companies, they have no debt. They generate lots of excess cash. They reward shareholders with a nice dividend and sometimes special dividends. And they have long-term growth. So we're very excited about that name. Visa and MasterCard obviously process a lot of transactions. Some people are using their credit cards more, credit card that's increasing, and certainly inflation's made it so the prices of goods are higher. These companies directly benefit from that because the transaction sizes are greater. Even if there's not unit growth, even if you're not buying as many widgets, since the price per widget's up, you're probably spending more, even if you're buying less in units. And again, that helps the processors like Visa and MasterCard. We have insurance companies like Principal and Prudential, and they're leaders in different niche areas of insurance. And we have Crawford that helps a lot of insurance companies. Insurance companies tend to be their major clients. When a disaster strikes, they provide a lot of services and send in adjusters and help see the claim cycle through, make sure the right people get paid the right amounts, and make sure that the rebuilding takes place. They have two main competitors, but both of those competitors have been bought by private equity firms. That's a great competitive advantage for Crawford. They're winning a lot of business because of that, gaining market share against these two main competitors, because the customers know that private equity will bleed a lot of cash out of these two companies that they bought. And they're not expected to reinvest in as much technology that might not have a great 6-year return, but might have a very good long-term return. the private equity firms have to flip their investments every 5 to 7 years. The major insurance companies don't want to rely on a company that's going to be flipped to other owners within 5 to 7 years and they bled dry a lot of cash. They want a company that is reinvesting in technology and making their customer experience a lot better. And Crawford's doing that. They have a lot of technology that they've built around letting the adjusters and insurance companies access information through cell phones. That's very important when you're on site of a disaster, and enter information that way, receive information that way through the apps that Crawford has created. So Crawford has 5 units. 3 are less cyclical, tend to have recurring growth. A 4th has just cycled into growing. The 5th unit is highly dependent on helping people after disasters. And they have to be insured disasters. So we can have disasters all the time, but if they're heavily insured, if there's been a lot of property damage and the insurance companies are involved, then Crawford gets a lot of business through that 5th unit. There have not been many insured disasters in the last 2.5 years. So there were a lot 2.5 years ago. Crawford then got the resulting business that lasts 12 to 18 months. Great. Now the last 4 quarters, that's wound down. They haven't gotten much revenue from that. So that unit has been depressed for 4 quarters, which means down. And now when we look at the next 4 quarters, it should be flat. If there are disasters, it should be up. So you had this one unit offsetting some of the growth of the other units in the last year. That should not recur. So the other units will shine through and continue to grow, and they'll make the whole company grow. There'll be accelerating growth. With the stock market, the second derivative, or acceleration deceleration, greatly affects the stock price. So we have accelerating growth from Crawford. Eventually, there will be insured disasters again, and insurance companies will need Crawford services from that 5th unit, and they will have even more accelerating earnings when that happens, and the stock price will do even better. So like our other companies, Crawford's very profitable. They'll be growing. We expect accelerating growth. And on top of that, with all the excess cash generation, there's share buybacks and dividend increases should continue. So we expect to make a lot of money off this stock, this new holding, even though not many people have heard about it. And that's the advantage of being able to pick through the different names and getting some great gems that are poised to take off. Another set of companies, quite diversified, cash cows, have attracted activists. These are individuals, partnerships, or hedge funds that think they can increase the value of companies by shaking up management or getting management to take more shareholder-friendly actions. That might result in a proxy battle. That's expensive. These 5 companies have experienced that, and those expenses, we believe, are now behind the company. They're now appeasing or working with some of these activists and making shareholder-friendly moves. So with expenses behind and shareholder-friendly moves being taken, such as share buybacks, which makes sense with lots of these companies, 3 of them have no debt and are sitting on big cash piles. And other moves could be to divest underperforming units or units that might not grow in the future, and focus and reinvest in units that are growing and do have competitive advantages. These make sense from a stockholder's perspective. Sometimes companies think of things from an operating perspective or other perspectives or empire building. Maybe they're not focused on just shareholder returns. And we expect this activist activity to actually entice management to make some positive actions. LifeVantage is one of our newer holdings. Not everybody's heard of it. A leader in direct selling of certain categories. Their comparisons are now getting easier as well. They're year-over-year comparisons. So we expect strong accelerating revenue growth, earnings growth, and cash flow generation. Again, that acceleration, that second derivative, greatly determines the stock price moves. In addition, they're launching new niche products, which should sell very well. And in the meantime, they generate a lot of cash. They're sitting on a lot of cash, have no debt. And so we expect share buybacks and dividend increases to continue at LifeVantage. So those are just examples of different companies we're invested in, all generating lots and lots of cash. And whether they pay down debt, reinvest in their future growth, buy back stock, increase dividends, we expect to make a lot of money off these stocks, and they'll benefit from the macro trends that Mark discussed. And then, Scott, you mentioned there might be an election coming up.
Yes, I did. So Mark and Tim have discussed the economic and investment cycles. I'm going to take us to the end of the presentation and talk a little bit about the effects of elections and fiscal policies, including taxes. So, yes, we have a presidential and congressional election coming up in 53 days. The fact is that whoever wins, and we don't know who's going to win at this point in time, is that there will be new fiscal and tax policies that can affect the economy and the market. Whoever wins, they will not be able to hide away from the fact that we face a $3.5 trillion national debt, which is larger than the economies of China and India, Germany, Japan, you name it. And though we don't know what policies could ultimately be adopted, whoever is the president and whatever control is in Congress, there will be a delicate balancing act when implementing new tax programs, spending bills to try to control and curtail the deficit, yet also grow the economy. So regardless of the election outcome, we can take comfort in the fact that the market has historically produced strong equity returns dating back to 1933. I do want to share a disclaimer with this chart. It does exclude 2001 returns due to Jim Jeffries, who was Senator of Vermont. He left the Republican Party and went into caucus with the Democratic Party, so they did not include 2001. Also, it's important to remember that 2001 was a pretty dramatic year, and we were facing a very challenging stock market environment with the dot-com bubble. Nevertheless, when looking at this chart, if you look on the left, when one party has controlled both the White House and the Congress, i.e. unified government, which has been the case for 44 years in this time frame, the average annual return has been close to 14.5%. Now let's look to the right of the bar chart, and you can see this is where the Congress has been split. The average annual return is still high, around 13.7%, not much further behind the unified government bar chart. And when Congress is controlled by one party and the White House by the other, which is the middle bar chart, the average annual return has still been good, and it was close to 12%. Again, to reiterate what I said at the beginning of this slide, regardless of the outcome, we can take comfort that historically, regardless of party control, the market has produced good and strong returns dating back to 1933. Also, post-election, it's important to look at and keep an eye on that there's been a large amount of cash that has been sitting on the sidelines that could potentially move back into the market. Stockpiling cash during an election year is pretty typical because folks are concerned and nervous about the uncertainty of the election results, as well as the negative press that is thrown at us day in and day out. We have shared how timing the market can be detrimental, but we do want to share the fact that this data shows that, as you can see, the last 30 years, on average, $195 billion has flowed into money market funds, short-term money market funds during an election year. That's the two bar charts on the left. It was estimated last month that there is over $1 trillion of investments in cash right now. That includes money market funds, but it also includes CDs, T-bills, and other short-term securities. Moving to the right, which shows the year after an election, you can see that the flow of funds flips back into equity funds. If this trend continues after the election, it could be very positive for the stock market in next year. That ends our presentation. As I mentioned at the beginning of this webinar, we have received several questions, so we're going to start digging into them right now. The first question is, Tim or Mark, can you explain the Japanese yen carry trade that affected the market last month, and can it happen again?
So the yen carry trade is when entities like hedge funds borrow from one currency, usually from of a country that has very low interest rates, and take that money and invest in a country that has higher interest rates. They might use a lot of leverage when doing that. It's very scary. They can sometimes use 50 to 1 or 100 to 1 leverage. So if Japan has a lower interest rate, say 0 to 1%, so you're shorting their bonds and use the money to buy U.S. bonds or other assets that are working, other assets that are moving up, like large cap growth stocks. Well, that works very well while it's working. However, Japan's central bank started raising interest rates. And when you raise interest rates, especially from such a low level, the underlying bond prices can move greatly. And so these entities were losing money in the bonds. All of a sudden, they had to pay higher interest rates. They started unwinding their trades. And as they did that, all at the same time, the investments that they had made, many of which were using a lot of leverage, they started to go down as these various hedge funds and others started selling the same investments. And so we saw some mega caps, some large cap growth stocks sell off in recent months. So these hedge funds were losing money on the borrowing side, whether it's the currency or the interest rates, and they're losing money on their leveraged investments. Sometimes this results in some hedge funds going out of business. They never advertise those results, negative 100%. But anyway, in some past cycles, the Fed's quietly stepped in and helped situations. But there was this yen carry trade. It started to unwind. That made them have to sell their investments, which could have included U.S. large cap growth stocks, and it hurt those individuals that were highly leveraged in playing these games. These are not traditional long-term investors, and when we see things like this happen, we can take advantage of that market volatility as the expensive areas of the market sell off, or as a normal company happens to sell off and move to a very attractive entry price. We can go ahead and buy that.
Okay. With fixed annuities currently earning guaranteed 7% annually at age 70, why would an investor not consider them versus dividend-generating stocks tied to the Russell 2000?
Well, the Russell 2000, probably less than half the holdings pay dividends. So I think that would be an odd comparison. But our dividend-generating portfolios tend to have yields of roughly 4 or 4.5%, and there's underlying growth. Many of them grow their dividends over time, and many of the stock prices also, the underlying stock prices go up over time. So the total return over many years can certainly be far greater than 7% a year. The tax rates could be lower. Interest is taxed at a full rate, but with stocks, the qualified dividends and long-term capital gains are taxed at a lower rate. There are various types of annuities and fixed income annuities. And so a 7% fixed annuity, there are various issues. One, there's counterparty risk. Even if you buy that annuity through a big firm like Fidelity, they're not taking any of the risk. They're taking a little bit of money. They're taking a cut. But they pass on that your annuity is with an insurance company they're hooking you up with. That insurance company might not be AAA rated. There could be some counterparty risks. The insurance company might not last as long as you do. So that's an issue. Now, the annuities tend to get sold, not bought. Salesmen get paid a lot. It's like a timeshare. The commissions can be up to 10%. And the insurance companies do well. The insurance companies make money. Well, if you're selling the 7% annuity, 10% of the money goes toward commissions. And so the insurance company, let's say, gets 90% of the money. They're investing in 5% treasuries. Well, they're paying you 7%. So either they're going out of business, or there's some clauses in there that you might not be aware of, such as you can't get your money back out. When looking at a lot of these, the surrender value is 0. And as well, there might be time frames where they pay out this 7% interest rate. It could be over 8 years. It could be over up to 40 years. But again, there are lots of clauses, such as if one or both of the customers die, the payments stop. Also, at the end of the payments, whether it be 10 years, 20 years, 40 years, there's no money left. So you don't get the principal back when you invest in growing companies, stocks that pay dividends and grow their dividends over time. Not only do you get those dividends at a lower tax rate, not only can they grow over time, but you also have the stock at the end of the 10, 20, 40 years. You still have your principal, and if your manager's done a good job, that's grown quite a bit over the 40 years, and that's a lot better than getting 0. So I am not attracted to 7% fixed annuities, paying a broker 10% immediate sales fee, and having the insurance company make lots and lots of money. Something else is happening, and I don't believe you've read all of the clauses in font 4 that say how you're not going to get all the money back that you think you're going to get.
Okay, next question is, with respect to growth versus value, isn't there a potential happy medium to have investments in growth stocks, such as technology, i.e., or for example, IBM and Dell, that have growth and also paying healthy dividends?
Yes, we are, I think, essentially growth at a reasonable price type managers, which is that happy medium in between growth and value. So we are always searching for and investing in companies that we feel like have great growth and are at attractive valuations. So we do have technology exposure in companies that we don't feel like are overvalued. And, you know, we put into Qualcomm on prior calls, but that would be kind of in that category, which are large cap tech name, is expected to have good growth and has had good growth does pay a nice healthy dividend and happens to trade at a much lower valuation than some of their peers. So I would say that's kind of in a similar category to what's being asked in the question. But short answer, yes. I mean, we're always looking for companies that have high growth and low valuation. And that's what we spend a lot of our time doing and are really focused on. And then, of course, we layer our cash flow analysis and make sure those companies have great cash flow characteristics before we buy them. So, good idea.
Okay, another question we have is how much big government expense inefficiencies do you think Vivek and Elon can discover, and will this have a market impact?
So when we look at companies of various sizes, they can always find areas where they can cut expenses or where they've been spending money and not receiving any good returns. So if companies can do that, what can a vast government do? So one of the biggest governments in the world has lots of sprawl over time, lots of growth over time, and not every area has been audited and restrained. It's a huge entity, and they can find different pockets here and there. The inspector generals of different divisions find a lot of fraud, waste, even abuse. That can be in the military where they can't track money, going certain places. What happened to all this money going in Afghanistan? A lot of it can't be tracked. It can happen in other areas. There's Medicare fraud, Medicaid fraud. That's been well documented and estimated to be in the tens of billions, certainly per year. You add up all the different divisions of government, and you can get up to well over $100 billion a year of areas of waste, fraud, abuse. Now, how to not only discover it, but also to shut that down is the trick. You don't want to try to detect waste and fraud and then cut off a bunch of payments from Medicare, Medicaid, Social Security, and some of those were legitimate and going to the right people, and all of a sudden they can't get their benefits. So it's very tricky to find those missing payments, those bad payments in real time to make sure the fraudsters don't get the money, but that legitimate parties still get the money. And so you'll need better computer systems that work with each other, that are updated. It's such a vast government with so many different computer systems. It's hard to get all of that done in a short period of time. But I'm sure they can find plenty, and hopefully they would be able to reduce some of this waste.
And we have another question here. With prospect of rate cuts, does it make sense to buy longer-term bonds?
So we would still recommend keeping bond portfolios relatively short duration, where a client has a bond portfolio or wants a bond portfolio. I've mentioned before, we've mentioned before, that the Fed only controls the overnight rate of interest, and the market controls longer-term interest. So bonds at 2, 5, 10, 20 years. And those interest rates have moved down considerably this year. So a lot of the benefit from lower Fed funds overnight rate has already been seen in the 10-year. I believe the 10-year Treasury is in the neighborhood of 3.7% today. It hit above 5 roughly 12 months ago. So we would not be attracted to loaning the U.S. government or really any company money for 10 years at a rate that is not that much higher than inflation. So right now the yield curve is very, very flat. So you can get the same amount of interest on a 2-year note or bond than you can on a 10-year bond. And we don't think there's much downside or too much lower to go in the market-controlled interest rates. So we would recommend keeping that money relatively short duration That way we are able to collect a similar or even higher, in some cases, amount of interest, and then we get our principal back sooner. So we think there's less risk in shorter duration bonds. And at this point in the cycle, or where we are with the yield curve, we're not giving up any return for that. So short answer to the question is no, we would not really recommend extending durations, even though we do expect the Fed to reduce interest rates next week.
Usually the yield curve is upward sloping. So right now it's downward from when you look at the spot rate being at over 5% and the 10-year being below 4%. But usually the 10-year is higher than the overnight rate, certainly by more than 1 percentage point. So with the overnight rate right now being 1.5 points, 1.5% greater than the 10-year, it could go down 2.5%, down from 5.5 to 3, and the 10-year could still go up from 3 3/4 to 4. So we don't think the long rates are going to go down all that much. There's also another game going on. The U.S. Treasury has shortened the maturities of all the debt of the federal government. They keep issuing Treasury bills. They're not issuing enough 10-year and 30-year Treasury bonds. And so the average maturity of the U.S. debt keeps going down. It's between 3 and 4 years right now. So over half of the United States government debt is coming due in the next 3 to 4 years. That has to be refinanced. Responsible Treasury would refinance it by issuing a lot of 5-year, 10-year, 30-year bonds. As they eventually do that, the supply of 10-year and 30-year bonds will increase. They have to sell those. The increasing supply will make it so that prices go down, which means yields go up. So there will be a natural underlying pressure for long-term yields to go up, just from a natural yield curve, but also from the eventual issuance of long-term Treasury bonds. It would be highly imprudent for the Treasury to continue to shorten the maturities of the overall federal debt. That would give us a great deal of risk and put us at the control of short-term bond buyers like foreign governments. That's the last thing we want.
Okay, we are running near the bottom of the hour, so I want to wrap things up. If you had sent a question, we weren't able to get to it, we'll try to address it individually. So thank you for sending your questions. The last thing I would be remiss in thanking our clients for the referrals that we have received over the last quarter. We greatly appreciate it. And if there's anyone else that you know that we can help with their investments, we would love to help them. Appreciate everybody attending today's call. Again, it has been recorded. We will post it on the website tomorrow. And have a great rest of the week. Bye.